JSW Steel is the next management on the show. It reported an in-line set of Q1 earnings. The top line was a beat on better realizations, but there was a small miss on margins. Nigel caught up with Jayant Acharya, the Joint Managing Director and CEO of JSW Steel, and began by asking him about the quarter gone by and how they see growth going ahead. Listen in.
As far as the prices are concerned, I think first on the raw material side, the raw material prices, as we had indicated, has dropped on coking coal by $23. We expect a similar $23 to $28 drop, let's say, in this quarter as well, which will flow into the cost in quarter two. Iron ore prices have started softening in India in line with the international price as well. Some part of that will again flow through into quarter two. So softer raw material prices will again support the margins. Steel prices in the month of June came down, while in the month of May there was an improvement internationally in India as well. But there were corrections in June by and large across geographies. And that resulted in some softer prices going forward into this quarter. We expect now the prices to remain range-bound and margins to be supported through a softer cost structure.
Okay, all right. Let's get a couple of aspects then going, Mr. Acharya. As you said, input cost, you'll see some bit of benefit of roughly around $25 per ton. So that's good news. Steel prices you're expecting to hold steady. I'm looking at EBITDA per ton for the India operations. Let's talk about the India piece first. It appears that the India EBITDA per ton has improved by around 550 to 600 rupees per ton. Do you believe that the trajectory is upward now and we continue to see an improvement in the India EBITDA per ton?
Yeah. So I would just like to clarify one point here. This quarter, in quarter one, we had some one-offs. So we had an impact of almost close to 2,000 rupees on account of inventory revaluation and some other one-offs in the balance sheet, which will be, let's say, not reappearing again. That's one positive. Secondly, from an India EBITDA perspective, as we discussed, the raw material prices, the softer raw material prices will flow into Q2, and that will support your margin. From a product mix perspective, if you see JSW Steel, we have taken a lot of initiatives to improve the product mix, and that has given us an upside. So in spite of a softer steel price, we could actually take the Indian, let's say the Indian realizations up by about 550 odd rupees per ton. Going forward, we expect that prices will be range-bound, but our efforts to continue to improve the value-added piece will continue. Last quarter, it was 64% of our total sales.
Okay, all right, 64%, got it. So that protects you all with regard to the steel prices. A quick word on the international business. That struggled in the past quarter. Do you expect a couple of more quarters of pain? If you could give us a sense on that. And since we're talking about the overseas business, also from India, you'll export steel, and that proportion came down to around 10%. Where do you see this number stabilizing at?
So from an India perspective, I think I would say that if you were to look at our past history, we have been in the range of about 10-15%. Last quarter, we went to 20% because there was a window of opportunity which we got for exports when people were stocking up before the summers. But however, the international prices in this quarter were muted. The demand also was softer, due to which we recalibrated our exports in favor of domestic market. The domestic market was very strong, and therefore we chose to put more tons into the domestic market, and therefore our sales YOY for domestic India operations went up by 14%, which is a very good number. The India operations delivered the highest quarter one sales ever. Driven by various sectors, like especially in the sustainable areas like renewable. We did the highest sale to renewable. We did the highest sale to packaging, which is the tin, which is replacing plastics. We did the highest sale to electrical steels segment, where the energy saving is very efficient, etc. So that helped the India operations quite a bit. As far as the US operations were concerned, I think there was a sharp fall in prices, which basically impacted the operation. The volume has been by and large stable. And we expect that going forward, we expect volumes to be reasonably at a similar level. But the outcome on prices is yet to be seen. Italian operations have been by and large stable in Q4 and Q1.
Okay.
Going forward into Q2, we expect that the Italian operations will remain stable to slightly better.
Okay, all right. What about the net debt number? It's holding at around 80,000 crores. You have a big capex plan as well. Does it move higher from here?
So, Nigel, this 80,000 crores, we actually allowed the debt to increase because we spent about 4,500 odd crores on capex. We paid about 228 odd crores for some of our mining areas where we were to start up the coking coal mines. So that is something which we wanted to do because we wanted to complete our expansion projects quickly. We also repaid about $300 million of acceptances, which is about 2,500 crores. So that basically resulted in the debt going up a bit, and some working capital build-up, I would say, for the operations which are coming on stream. So from that perspective, the debt got built up, but I think it's well within the range. And as the working capital gets released, you will see an improvement in the ratio levels as well.
Got it.
The net debt to equity remains flat. I think it's still below 1.
Okay, all right. Are you looking at any inorganic growth? I need to ask you that question because Mr. Agarwal is saying that he's a seller, but he's a seller at more than $1 billion for 1 million tons of steel. Are you interested in that asset? And any movement on NMDC Steel? Last time you said that maybe post-election something could move. Have you heard anything?
So, Nigel, on the first one, I think we remain interested in the mining assets, but not in the steel asset. In the second one, which is NMDC, we are hearing something from the media, which I think you are reading as well. We will wait for any official announcements to go ahead. We have anyway given our expression of interest, and we will see how it goes. On any other inorganic assets in India, no. Our interest on our mining areas in coal remains for prime hard coking coal, which, as we discussed last time, we continue to look for assets which make strategic sense for us.
All right, final question. What about the budget 2024? What do you expect?
So, no, I think the good thing about post the elections, the government has now come back. We see a renewed interest and focus on the oncoming budget on 23rd. We expect that the infrastructure and capex spend which the government has been doing will continue. The focus on manufacturing and energy transition will continue. They may take some steps to improve consumptions and general welfare and social initiatives, which is good. On the specifically for the steel industry side, I think I would say that the Indian steel industry is really trying to come up to the National Steel Vision Policy and the vision of the Honorable Prime Minister to make in India and be self-reliant. A lot of capex is going into the creation of capacities. We should not allow, because India is growing at a very fast pace, the surplus steel which is now finding its way into India, we should not allow that to happen. Rest of the countries have blocked it. India should take proactive measures quickly to see that this unfair trade does not take place.
All right. Well, that's Mr. Acharya guiding for better times ahead. He's saying that steel prices will stay stable, but they'll get some benefit on the back of lower costs, and also calling in for some measures to protect the domestic steel industry.